Hello class. So the last lesson in our course covers the statement of cash flows. Throughout the semester we have learned there are four main financial statements. The first one is your income statement. It measures your revenue compared to your expenses, and it would list any gains and losses also to calculate a net income. Then we focused on the statement of stockholders' equity in the last chapter, chapter 10. Then you would create a balance sheet, and then the last statement you would create in that specific order is the statement of cash flows. The statement of cash flows will measure and communicate. Those are two key words for the entire semester. Also good to note on your final exam, but it measures and communicates your cash activity for either a month, a quarter, or a year by breaking it down into these three sections. Operating will include revenues and expenses, anything that you incur to operate your business, and it will also include interest. I note that one because that one seems like it would go in one of the other two activities, but interest, no matter what the interest is on, is in this category. Investments include any long-term assets that you purchase or sell, not just the buying of them, but if it's a building, a land, intangibles, all of those items, when you buy them, you purchase them to get some kind of return. So those are your investments. And notes receivable goes into this category. If you loan out money, you would charge interest. So you would put the interest in the operating, but the actual loan itself, where you're loaning out funds, is an investment. I also want you to note that buying other companies' stocks, not your own, is an investment, or putting your money into a CD. And then the last category is the financing. That's when you would borrow funds, also noted as notes payable. If you are to pay out a dividend, it goes into this category. But if you receive a dividend, that's operating, because it would be dividend income. So the three in this category are borrowing, paying dividends, and issuing your own stock. So issuing common stock. If you buy back that common stock, we know from chapter 10 that's called treasury stock. That would also be in this category. So that is the first part of the chapter, knowing what goes into each classification. And then the next part of the chapter, I'm going to explain how you would calculate net operating income, the operating cash flow from the net income. That's part of the indirect method, which we will focus on because it's part of your generally accepted accounting principles, and it reconciles, it shows how a company can have a net income of some amount of money and have a totally different amount of cash. So it explains the difference between their net income and their operating cash flow by adding and subtracting transactions that are already included in the net income that shouldn't be if you were trying to get to your cash number, or adding things back that really are cash that aren't including in net income. So that is the latter part of this video. Okay, for this next part of the video, I'm going to start by showing you a few transactions that I just recorded for the first part of January. It says that the company provided services on account in the first transaction. Second transaction, they provided services and received cash. The third transaction, they purchased some prepaid insurance. The fifth, on January 5th, fourth transaction, they used some supplies. January 14th, they recorded salaries, expense incurred but not paid yet. And then on the 15th, they paid off part of their bill, part of what they owed from last month, from last year. So all of these are the January transactions. From these transactions, I've highlighted the items you would need in order to calculate net income. It's just the revenue of $17,800, equaling a total revenue of $25,000, minus the two expenses I have recorded. Nothing else goes into net income. So $25,000 minus $11,000 gives you a net income of $14,000. Then if you wanted to explain the cash balance at the end of these transactions is $4,000. It started at 5, and then I took all the debits and credits from the previous transactions, and I came up with the new ending balance. So I'm going to explain for the latter part of the video how the beginning balance of your net income is $14,000, and the cash balance of the company is only $4,000. By adding or subtracting anything that's included in net income or is not included in net income that has to do with cash. So this part at the bottom here shows you where I've already analyzed if the account balances have increased or decreased. We only do this type of reconciliation for the operating section of cash flow. We look at the current assets and the current liabilities, and we find their change in their account balance. At the beginning, before I recorded any January transactions, accounts receivable balance was $2,000. At the end of January, it's $19,000. So that increase is something I would analyze on my operating cash flow. The increase in accounts receivables means I have revenue inside that net income, but it's not actually cash yet. So I need to subtract it out of the net income if I want to get down to my total cash for operating cash flows. You're going to learn the rules that if you have an increase in an asset account, you want to subtract that increase because that is something that you probably, for example, prepaid insurance, used cash to purchase. Also, if it has to do with another asset such as accounts receivable, it's a revenue item, but you haven't actually received cash yet. So increases in current assets are going to be subtracted out of the net income because we're trying to reconcile or get down to our total cash. For the rest of the video, I'm going to show these changes on the whiteboard. Okay, as I stated, the net income from all of those prior transactions for January 1st to January 15th is $14,000. That's your revenue minus your expenses. But most of that revenue is because we provided services on account. So to get to our true cash number, we're going to have to subtract an increase in accounts receivable. It makes sense on the opposite end to most students. If you had a decrease in accounts receivable, that means you actually would have gotten cash. But when you think of that journal entry, receiving cash and crediting accounts receivable, you didn't actually put that in as revenue again. So when you're trying to get to the true cash number, if you have a decrease in accounts receivable, you must have received cash. You're going to add that. But if you have an increase in accounts receivable, you recorded revenue and you didn't really get cash yet. So you want to subtract that item. All of your current assets will be subtracted if they have increases. The next item on our list is an increase in the prepaid insurance. So if you have an increase in an asset, you want to subtract it. Increase in the prepaid insurance. Prepaid insurance is an asset. I purchased it. I got more of an asset. And theoretically, I would have paid for that with cash. So I'm going to subtract that increase. The next asset I have, it says I had a decrease in my supplies. So a decrease in supplies means you recorded some kind of expense that made net income go down. Expenses decrease net income. But we didn't actually pay out any cash for that expense. We just used up another current asset. So if we have a decrease in an asset, a current asset, we're going to add it. This reconciliation is only done for the operating cash flow. The fourth item I have is a decrease in my accounts payable. The accounts payable decreasing means I must have paid out cash. We only pay off our reduced payables by paying them off with cash. So the decrease in the accounts payable is going to be a subtraction. It's linear. If this function is decreasing, you should subtract that from the net income. If you have an increase, which we do on the next one, on a liability, which I have a salaries payable, if I have an increase in a liability, I'm going to add that. So the assets are opposite. Think of the accounting equation having to balance. If I increased accounts receivable, and I know the other account I'm kind of analyzing right now is cash, that would have to be a subtraction because it's got to balance. One asset can go up and another asset go down, and the equation still balance. But on liabilities, if you have a liability go up, the other side of the equation is where the cash is sitting on the asset. So you're going to have to add that here. So then you can see if you're reconciled, if you know what your total operating cash flow should be, and I do, mine should equal 4,000. So here we're looking at a -3, -9, -7, -10, +9 would give me down decreased by $1,000, and that's the change in my balance. It went from 5 down to 4,000. So your net operating income is the only thing you have to, section of this statement of cash flows, you have to use to do this analysis. And once you have totaled up each section, the operating cash flow, the investing cash flow, and the financing cash flow, that change in cash is what you can balance to. Mine has a change in cash of $1,000 from 5,000 to 4,000 on your statement of cash flows. So this is my total operating cash flow change. If I had depreciation expense, I would always have to add that in. If I had a loss, I would have to add that in. And if I had a gain, I would have to subtract that. Those are the items you use to analyze the operating cash flow.